Last week, Silicon Valley Bank collapsed, causing uncertainty for its customers and investors. Silicon Valley Bank, commonly referred to as SVB, was taken over by federal regulators after facing a sudden bank run and capital crisis. This marked the largest failure of a US bank since Washington Mutual back in 2008. Who are SVB? Established in 1983, SVB specialized in banking services for tech startups and provided financing for almost half of US venture-backed technology and healthcare companies. The FDIC reported that the SVB was among the top 20 American commercial banks, with total assets of $209 billion at the end of last year. But why did it fail? Several factors contributed to SVB's downfall. The Federal Reserve began raising interest rates a year ago to control inflation, which resulted in higher borrowing costs that negatively impacted tech stocks, which SVB was benefiting from. Then the value of long-term bonds, which SVB and other banks acquired during the era of ultra-low near-zero interest rates, was also eroded by rate increases. SVB's $21 billion bond portfolio was yielding an average of 1.79%, while the current 10-year Treasury yield is about 3.9%. As well as that, venture capital began to dry up, causing startups to withdraw funds held by SVB. This led to a situation where the bank was grappling with unrealized losses in bonds while customer withdrawals were increasing. On Wednesday, SVB sold some of its securities at a loss and announced plans to sell $2.25 billion in new shares to pump up its balance sheet. This prompted a panic among key venture capital firms, who advised companies to withdraw their money from the bank. The following morning, the bank's stock plummeted, dragging other bank shares down with it, as investors feared a repeat of the 2007-2008 financial crisis. By Friday morning, trading in SVB shares was halted, and the bank abandoned efforts to raise capital or find a buyer. California regulators intervened, shutting the bank down and placing it in receivership under the Federal Deposit Insurance Corporation. While analysts do not expect SVB's collapse to trigger a domino effect in the banking industry, smaller banks disproportionately linked to cash-strapped industries like tech and crypto may experience a bumpy ride. And that's what we know so far about the Silicon Valley Bank collapse of 2023. Thanks for watching, and be sure to subscribe to keep up to date with the latest news.